All right, well, welcome everybody to our first of the year webinar. Today we're going to be talking about 2025 financial markets outlook, and this is the part of the webinar when I stall for time as people slowly log in and filter into the webinar. We're pretty excited about this webinar, and we'll get into introductions in a second. We've already got 14 attendees, so hi Bruce, Craig, Fabrizio, Jaspal, Linda, Lucille, Patrick, Paula, Peter, Rick, Ramit, Vince, Willem, and Yvonne so far. And I know we have other people expected. So today we're going to be talking about the 2025 financial markets outlook. And Leah, if we can just go to the next slide, please. And this is a really fun disclaimer that we're asked to show by compliance. So if you're having trouble sleeping, just pull this up later on in the recording. And I think that's about enough time for that. So as you know, on the call today, we have our team. We have Erik Wachman, we have myself, Per Homer, we have Jeff Wachman, we got Leah, who handles all our marketing and does some client service stuff as well. We have Joan, she handles client service and booking meetings. And then, of course, we have Kashfi, our intern from University of Toronto, Mississauga, here helping us on Mondays, and so she gets to listen in and so forth. Before I get into introducing Vince and Claudine, who are our guest speakers, I thought I'd let Jeff, the founder of our team, take a moment to share some thoughts and say hello.
Oh, well, hi, thanks, Per. So I'm in I guess, the heat of the action down here in Florida. It's a big day, as you know, the 20th. I don't think I'm going to tune into this famous transition of power, but it's certainly causing a lot of anxiety and a lot of stress. I think I want to welcome everybody, first of all, to the seminar, which is great, and I'm glad I got a chance to say hello. I think the answer for us down here is, whatever you hear, you might as well completely ignore, because a lot of it's bluster and a lot of it's talk for the sake of a reaction. It's better just to settle back in and wait to see what actually transpires. That's on the non-market side. On the market side, it's going to be an interesting time, and I'm as curious as all of you to hear what the experts in the field have to say about what they can see in their crystal ball going forward. The only comments I have is that, believe it or not, the last few years have been excellent from, in many respects. A lot of it had to do with recovery from the COVID years, but I mean, there've been good, strong markets, reasonably low interest rates, good employment numbers. So, I mean, all healthy signs. Now we've thrown a lot of stuff in the air, a lot of balls in the air for whatever, for political reasons, perhaps, and we'll see how it impacts lives going forward. So, without saying more, I look forward to hearing Vince and Claudine and Per and Erik, and again, I welcome everybody to the seminar today.
Thanks, Jeff. So I wanted to introduce, maybe we could start with Claudine's slide first, Leah, please. Okay, we're going to introduce Claudine. She's our new district vice president with Fidelity Investments. Claudine recently joined us at the start of year. She's quadrilingual, so she speaks English, Spanish, French, and Italian. So she's great to take on a European road trip. Claudine probably will chime in a little bit, but really our main speaker here is Vince today. So without further ado, maybe go to Vince's slide, please, Leah. Thank you. Vince is an ETF strategist, at Fidelity Investments. He is just generally a really smart guy. He's in charge of communicating Fidelity's ETF product strategy, industry trends, and thinking about portfolio construction ideas for clients and our prospective clients. So Vince is going to go through, he has a huge slide deck. He's condensed it down to a few that he wants to share with us today. He's going to talk for about 25 minutes or so. and then we'll open it up to questions. Some of you have sent in a few questions ahead of time, and if you can just put them into the Q&A section of the webinar as we go along, Erik will moderate that and go through it at the end. So that's awesome. And we good to rock and roll?
I'm good.
Good. Okay. Looks like everybody signed in is going to. Everybody admire the paddle in the background there. It's quite lovely. And Vince, thanks for joining us. And I'll turn it over to you.
Thank you so much. Thank you for having me. And everybody, thank you so much for joining us today. I apologize for the voice. I do believe I am coming down with something. So hopefully it passes. But apparently there's a few bugs going around. I do have a little one that's in daycare. So effectively, he's the plague. And he just keeps bringing stuff home to me. But with regards to the presentation, first, I'm just going to give a quick background. I am an ETF strategist, and I primarily focus on our factor-based ETFs. So I just want to give an update of what a factor is, because I might start dropping these words. I just want everybody to be on the same page when I kind of say them. Then I'm going to give a quick review of 2024. A lot of it kind of is spilling over to 2025. 2023 spilled over 2024, 2025. I'm going to be talking about the two drivers that are really kind of moving markets, unemployment and inflation, because that's really what dictates asset prices. Then I'm going to be talking about what we're looking for specifically in US equities and then US fixed income, because most people want to know those. And it's the old adage, if the United States sneezes, the world catches a cold. Funny that I'm sick, and kind of like ways of diversifying things along those lines. So with that, I'm going to start off with the first slide. And the first slide is just so we're all on the same page. Let me know, thumbs up when people can see it. Perfect. Okay. So there's different ways of investing. Most people think that ETFs are passive. They just track the S&P 500. So when I start talking about active ETFs, because we at Fidelity are launching active ETFs, people are like blown away. But ETFs can be active or passive, same with mutual funds. And there's different ways of generating outperformance with an active manager. So I give the example of the X Factor, the TV show. There's judges and 1,000 people show up and 1,000 people all want to be famous. There's only a handful, maybe 50 to 100 can actually sing, dance, and so on and so forth. So in the X Factor, I think it's Simon Cowell, Paul Abdul, whoever the judges are. And one's looking for singing, one's looking for dancing, et cetera, et cetera. And that's what portfolio managers do, right? So you're going to hear phrases like low vol, quality, momentum, things along those lines. And if you know some of our active managers, Mark Schmel, he's a momentum-based investor, Dan DuPont, low volatility, et cetera. So we at Fidelity have been studying factors since the 1960s. So over half a century, we've been analyzing our active managers, Peter Lynch, the best and greatest, Will Danoff, trying to figure out how they generate outperformance, and we launched an ETF suite based off of that. But for your purposes, there's a lot of factors that a lot of you are familiar with. So value, Warren Buffett's favorite, right? Buying things below their intrinsic value typically outperforms. Momentum, you can think of Mark Schmel, global innovators, buying things that are showing positive change. Dan DuPont, always looking to protect the downside. And, Will Danoff, quality, financial health companies that are growing. Each one of these do have different risk return characteristics. So value typically does well in the beginning of an economic expansion, momentum in the middle, quality, you've heard the saying before, high grade your portfolio entering into a recession, and low volatility for a recession, protecting the downside. So when we look at 2024 performance, as Jeff mentioned, it was a stellar year. Like across the board, if you're looking at 2024, you're looking at significant gains across the board. And it matched 2023. So you're having two back-to-back excellent years. US equities returning 36% and 23% in the last 2 years. This is in Canadian dollars, so there is a currency conversion. And when we start looking at what happened in the United States, it was a spillover with regards to 2023. So at the end of 2023, it's maybe 3 or 4 price cuts, rate cuts projected into 2024. That quickly accelerated to 6. That was a risk on trade. So value momentum started doing extremely well. And then as the rates kind of decreased, or rate cut expectations decreased, things like quality momentum then started taking over. And then as interest rates were projected to stay lower or cut, things like mid cap and small cap started to do extremely well. So 2024 was kind of one of those years, very volatile. So first it was mid cap doing well, then it was momentum, then it was value, and it was going back and forth. But to the end of the year, there was an election that happened, and momentum really took off, and growth stocks, the Magnificent Seven, representing almost half of the returns of the S&P 500 last year. Another surprising thing that happened last year was gold. Just out of the trenches, didn't do much for a while, 3%, things along those lines, then started trading at all-time highs. If you think of gold, it is an inflation hedge. So there is a segment of the market that thought as interest rates were being cut, inflation might rear its ugly head again, and people were looking for hedges towards that for a number of reasons. So with regards to things to keep an eye on in 2025, there's the two things that the Fed is doing, and that's the unemployment rate. So the Fed has a dual mandate. So they have to maintain full employment and control inflation with the target of 2. So unemployment in the United States is at record lows. So in 2024, half of American states were trading at or had state unemployment at all-time lows. 1/4 in 2023. So there was a record amount of unemployment, and the Fed was kind of concerned that as people were working, they'd be generating more income, and that would kind of stimulate inflation. So that's kind of why they went into this hiking cycle. And if we look at the data, there's still 10% more job openings in the United States than there was prior to COVID. So the job market is doing extremely well. The one thing is, if you start looking at kind of the uptick in inflation, so again, 3-4% unemployment, record lows, but there's something called the SAM rule, SAHM, and it's when the unemployment rate increases by 0.5% over a rolling 12-month period. It's an indicator of a potential recession. So that SAM rule was triggered late last year because of the increase in unemployment. But Sam, Claudia Sam, went on Bloomberg the same day that it was triggered and said rules are made to be broken. So even though it was a perfect predictor of recessions going forward, it's the reason for those recessions that happened. So it's not that people were being laid off, it was people were entering the labor force and not being able to find jobs. So in the United States, you have record low unemployment, and here in Canada, we are getting an uptick. And again, our uptick's a bit more severe in terms of unemployment. And again, a lot of it has to do with not layoffs in general, but a lot of new immigrants are finding it difficult to find jobs, and a lot of youth are finding it difficult to find jobs. So again, it's not necessarily the economy slowing down per se, but it's people having the right fit and the economy growing enough to help these people. So here in Canada, again, it is accelerating, but we have a political election coming up this year, and hopefully we have policies coming forward in Canada to help the Bank of Canada kind of take off the pressure from their monetary policy on what they have to do. The other aspect with regards to the Fed's policy in the United States and here in Canada is core inflation or inflation in general. So around the world, the kind of target is approximately 2%. And most of the countries are good at kind of maintaining it in that range. There wasn't really inflation for the better part of 15 years, mainly as a result of the great financial crisis. There wasn't economic growth or prosperity. However, COVID happened, and now, we've increased interest rates, we've brought inflation down within range, but not completely within range. And the biggest problem with regards to the core inflation are certain metrics in the core inflation, and that's services. So it's people's wages that are kind of stuck there. So goods inflation is kind of rolled off. So back in the day, everyone wanted a crock pot, everyone wanted a Peloton, and prices have kind of jacked up on those particular items, causing inflation. All of that is kind of rolled off. And it's just the search for wages. And, the cumulative inflation was approximately 20%, and people want their wages to catch up. So there is that services inflation that is extremely sticky. And again, if there are tariffs or things along those lines, then that could be a negative tailwind to goods inflation, and that might rear its ugly head. So unfortunately for the Bank of Canada and the US Federal Reserve, they do have to keep a very close eye on services inflation specifically. Now, with regards to the US economy. So the US economy, or we might even say it's US exceptionalism, it's Fortress America. Over the last few years, there's been a lot of names for why the United States was expected to do so well. And for good reason. The United States is the largest economy in the world. It has a lot of excellent companies developing a lot of excellent needs-based products that are being exported around the world. And a lot of people are buying US products. And if you start looking at the PE ratio, and a PE ratio is what are you willing to pay for $1 of earnings? And if you look at the 10-year average for the United States, it's at around 19. And right now it's trading at about 23. If you start like backing it off for a number of reasons, if you go back 30 years, it's typically 15%. So we're trading at very high multiples relative to the United States, trading at relatively high multiples to itself and the rest of the world combined. You can ignore the world because 60% of the world is the United States. But if you look at Asia, Europe, Japan, Canada, they're kind of all trading in line, and people are really hiding in the United States. And when people are hiding in the United States, the biggest risk that we see is everyone trying to get out at the same time, right? So these PE ratios are effectively the Magnificent Seven, right? If you remove the Magnificent Seven, this does come down materially. And the other thing is, if you look at the market capitalization of the S&P 500, the top 10 companies account for 40% of the market cap in the S&P 500. So they are really pulling that PE ratio forward. And the PE ratio is one of those things that they do trade at higher multiples. So the United States is always traded at a higher multiple than Canada. United States is very techy, health core, very innovative, so you're paying for future growth. Canada usually trades at a lower multiple. So we're oil and gas, very boring things. Nothing really, no Canadian company is going to put anybody on Mars. Whereas there could be companies in the United States, 3 billionaires are competing to do that. So when you dig down a bit deeper into technology in the S&P 500 actually trades at a higher multiple relative to other sectors, financials, industrials, utilities, because technology is going to innovate. They're going to create driverless vehicles, cancer cures, things along those lines. And when you look at the PE of the tech sector specifically, it's trading at an extremely high multiple. So not to nerd out, but there's something called sigma or standard deviations. The tech sector is trading at 5 standard deviations outside of its historical average. So 1 standard deviation explains 60% of occurrences, 2 standard deviations, 95, 3, 99. This is trading at such a high standard deviation that there's 2 things that can happen in a PE ratio. Either the earnings increase, it's a numerator and a denominator. Either the earnings catch up or the price comes down. And the one concern with the Magnificent Seven and the S&P 500 is that the Magnificent Seven did trade at extremely high multiples for a good reason. They were generating anywhere between 30 to 60% earnings growth relative to the S&P 500 in 2023. So they were just generating, like during COVID, everyone's doing Zoom and things along those lines, so people were investing in technology. But as we're going forward, that growth rate went from 50 to 30, and the projection for next year is just 2% earnings growth relative to the S&P 500. So that's the big concern. Like they are forced to maintain their earnings growth if they want to trade in line. And if you just look at history, you know, the markets are mean reverting, right? They go outside of their average and they go under, and they kind of always come back to where they do. If you look at how big the S&P 500 is trading relative to all its major peers in the world, it's at a materially high valuation, which means that its earnings need to maintain its growth trajectory, or there could be a substantial correction in their prices. So that's something that we're mindful of. And we start looking at forward earnings projections. So earnings drive market performance. So we kind of see earnings come down, we can see prices come down, and we're looking at earnings kind of like turnover. So if the president-elect does have these stimulative powers, there's definitely this possibility that earnings do grow. But another thing that we are definitely keeping an eye on is that a lot of these Magnificent Seven generate their income from around the world. So Microsoft sells Office to Europe, they sell Office to Brazil, so on and so forth. And if there are these this flight to the US dollar can appreciate. So you saw us earlier today, the Fed, the president-elect mentioned, he's going to be the president in about 10 minutes, that he's not going to do across the board tariffs, but it might become instilled and the US dollar drop. So it's one of those variabilities. As the US dollar increases, foreign currencies decrease, and that could put margin compression on these multinational large cap. So that could be a drag that might come forward in these mega cap names. So that's kind of what we're seeing and paying attention for in the US equities. With regards to US fixed income, there's something called a yield curve. And I never really talked about fixed income in my 15-year career because I never really had to. Interest rates were zero. The Fed just did yield curve control. So there's really no reason to add a 10-year bond that pays 1% because it would just start increasing, right? And as the yield increases, the price drops and it hurts your portfolio. And that's what we saw in 2022, right? The Fed started increasing interest rates rapidly, the price of bonds, the stock market, all meaningfully corrected. So when we start looking at the US yield curve, there's a few things that we have to start looking at. And the first is R star. So there's a natural rate of unemployment or natural rate of interest rates that keeps the economy going. You can think of it being neutral in a car. If you put it in drive, you're going forward. If you put it in reverse, you're going back. And that's what the Fed is doing. It's kind of increasing or decreasing interest rates to move the economy forward and back. But there is this rate of interest that keeps the economy humming. And back in the day, everyone assumed it to be 0.2. The issue now is if you look at the dot plot, one Federal Reserve thinks it's 0.5 and the other thinks it's 4%, right? So once you go, the natural rate of interest is, let's call it 3%, and inflation could be 3%, their rate might need to be 6, right? So it is this variability that might happen in the overnight rate. And then once you start going further along the yield curve, there's a number of other issues that happen with regards to like the 10 to 30 year. And that has to deal with growth trajectories, right? So if you are stimulating the economy, your long-term growth rate should increase. So your yield curve should steepen. So one thing that we're seeing in the bond market, or what we think we're going to be seeing in the bond market, is a lot of volatility, right? If the Fed is not sure if the natural rate of employment, natural interest rate is 0.5 or 4, and inflation might be 2, it might be 3, and the United States is spending approximately $1 trillion every 100 days, they're taking in a lot of debt. And as you are creating that debt, that $1 trillion every 100 days, people need to buy that. And if you are issuing a 10-year, you're hearing in the news bond vigilante. So the FOMC is not buying those yields. Japan is kind of selling them off. So mom and pa's are looking in their portfolios and deciding at what price we want to buy these fixed income securities. And that is going to cause a lot of volatility in the portfolio, in the fixed income individuals' portfolios. The other thing that we're noticing in the fixed income market is that the credit spreads are extremely tight. So the illustration here is of the US government. So when the Royal Bank or CIBC issues a 10-year bond, it's usually treasuries plus a certain spread on top of that because they're a bit more riskier than the United States or the Bank of Canada. And the credit spreads are at historical lows in single percentiles. So the thing that we're concerned about is if there is a hiccup that happens in the United States or here in Canada, those credit spreads might blow out. which might cause a lot of volatility in the investment grade and high yield market. But that being said, one thing about fixed income and equities is that when interest rates fall below, or when inflation falls below 3%, equities and fixed income show a negative correlation. So if you start looking at these times where there's a drawdown in stocks, usually investment grade bonds do act as a ballast. So of course there are situations where there's a pandemic and or a banking run during the Great Depression that they show positive correlation, but typically in a broadly diversified portfolio, they offer a hedge against one another. So if people are concerned, what we are expecting is if people are running away from the Magnificent Seven because they're concerned and they can get a 6% yield in fixed income, and their IPS says they just need to generate 6.5, we do think there's going to be a lot of opportunities across equities and fixed income, investment grade, and high yield. And again, if you just look at your standard 60-40, if you're just in cash or fixed income, you're hardly generating anything. But if you have a standard 60-40, you're generating approximately 9% return, and the volatility kind of increases slightly for nominal returns, right? So it's an excellent way. So in summation, when you have a lot of volatility and a lot of unknowns, especially effective in 3 minutes, we think there's going to be a lot of volatility and there's a lot of opportunities in a lot of asset classes. And we think that diversification for 2025, especially since all of our factors generate exceptional performance and we're seeing real value. No longer are you buying fixed income because it's your compliance department tells you, but you can generate 5 or 6% return in a client's portfolio. So that's something extremely meaningful that can hedge with your equity portfolio. So with that, I think I got it to 12 o'clock. So we'll open up for any questions.
Good stuff. All right. Well, thank you, Vince. Hopefully that gives some context and some clarity as to what happened last year, where we're going. We had a really good amount of solid questions come in from our participants today. So thanks again for everybody for hopping in. Let's kick off with, big event today is what's going on down south. Yep. So how does Fidelity think about how a change in, say, geopolitics, and how does that affect portfolios? Can you talk about maybe the asset allocation, how you look at the US as a part of the portfolio, how that might affect Canada and international? So your thoughts on how, from a macro perspective, that affects things, without giving any predictions.
So I think during my presentation, I actually left out a name, and that was on purpose because markets are driven based off of fundamentals, earnings, PE, earnings growth, innovation, things along those lines. And if you think of any model, there's 7 factors that kind of explain the risk return characteristic. And then there's this error, right? Like if you took stats and it's called idiosyncratic risk. I forget what that symbol was, but there's something there to explain away the things that you can't really explain through the model. And the president-elect, or the soon-to-be president, just increases that error, right? It increases the volatility of the client's portfolio. And I remember in 2017, I was doing presentations, and it was my first rodeo because nobody knew what to expect, right? So 2017, you'd be on stage and there's this weird question about a tweet that went out, and you're caught on your back foot. 3-4 years into it, it's kind of like just rolls off your back. You're like, oh, did he? Oh, okay. But historically, his bark has always been worse than his bite. And he usually says, I want A, B, C, D, E, F, G, but he gets A and B and then says he got everything he wanted, right? So the neighbors down south, it is going to increase a lot of volatility, but the thesis and the understanding is to look through that, right? Anyone on their bingo card saying that we'd be talking about Greenland in January, like in October, we're going to be talking about Greenland in our meetings. No strategist had that on their bingo card. Canada becoming the 51st state, no one had that. And it is kind of falling away. As he said, like he's going to smack a 25% tariff on anything. There's this big knee-jerk reaction. And now he's going to do it strategically and tactfully and things along those lines. So it is going to increase the volatility. And that's why broad diversification across asset classes to make sure that each part of your portfolio hedges each part out is probably the best plan going forward. Generally speaking, he is pro-America, and which is a good and a bad thing. The United States drives the global economy, and everyone will benefit as they grow because of importing and exporting, trading with other countries. The issue is what's the word? He'll put the interests of his country before anyone else's. And you want it to be like he renegotiated NAFTA and it became the exact same agreement. Now he wants to renegotiate again. It'll be so it's kind of like, you know, you want to play in the same sandbox nicely, but it's one of those things that he will try getting more than providing others, which could be a hindrance. And sometimes I think, like with his tariff comment, especially auto manufacturing, components go to Canada. Like we send ore to the United States, it gets put into a fender, it gets sent to Magna sends down. Like this components cross the border several times in the supply chain. So how he was even going to like handle this is a lot of us are trying to just figure out his logic. And sometimes it's just, don't miss the forest for the trees, right? Look at the big picture. Where's inflation going? How high interest rates are going? And what does growth look like?
Can you, talking about the big picture, can you maybe lift the veil on how the portfolios or maybe the all-in-ones or some portfolios are being managed from an asset allocation perspective and how that's shifted maybe say from 2024, given what we're seeing now in the global economy? Can you give some thoughts as to how positioning, say, between equities and fixed income, any thoughts on that as we look at the economy as a global backdrop?
Yeah, no, so excellent question. So our all-in-one suite is a strategic core holding, right? So we know that factors in the long run generate alpha or outperformance. And it is when you start trying to time these factors. So at the beginning of last year, a lot of strategists were saying quality is going to be the factor that you want to own. And it kind of market performed. Because if you look at the business cycle, we thought we were entering into a recession. They got to start cutting rates. And a lot of our competitors had these models that tried timing these things. And the issue is, you know, if you look at the LEI, the leading economic indicator, it dropped below 5%. Anytime that happens, a recession happens. The yield curve inverted. That means a recession. The SOM rule with regards to unemployment, recession. So all these indicators that usually work didn't work, right? And it's making these knee-jerk reactions that our all-in-ones don't actually make. Right. So we actually in the equity sleeve screen on a quarterly for momentum and a semi-annual for the three other factors, high quality companies trading at fair valuations, exhibiting positive price momentum and lower volatility. And when you kind of screen for that in a portfolio, in our US sleeve, we have about 250 names. We are underweight to the Magnificent Seven. We are trading at a lower PE, generating higher free cash flow. And that's a portfolio you kind of want in this market that's a bit more resilient. So it's not what you own, it's what you don't own, right? So if the Russell 2000 is 40% not profitable, why would you want to own, what is that, like close to 1,000 names? Like, so we go through a very rigid scoring mechanism and we remove the emotion out of it. And it seems to be working for us because at the end of December, on every standard reporting period, we are 100% peers beaten. So that's a 1 month, 3 month, 1 year, 2 year, 3 year, and since inception for the majority of them.
I have a.
Yeah, go ahead. You mentioned the Mag 7, so if you had a question on that.
Well, I did. I think some explanation for everybody out there with how small a slice of the overall market that Mag 7 is, and how average the rest of the companies in the U.S. market have done when you take out that sliver. But I think there's a fair number of us who travel, and currency exchange is something that's been on the table and talked about, with the Canadian dollar trading at somewhere around 68 cents, 69 cents. And how, you know, politically and in the media, they've been playing on the fact that, you know, the Canadian dollar is so weak, and and it's only getting worse, and our economy is underperforming, and it bugs me. I'm down here, by the way, so I have to use American dollars. It bugs me because if you look at other currencies relative to the Canadian dollar, and other currencies relative to the US dollar, you find that, in fact, Canadian dollar is getting stronger against other currencies like Australian dollar, like the euro, like the yen, and all these currencies have been impacted by this kind of rush to buy American, I guess, instruments. But I see the world conspiring to bring down the US dollar, to be honest with you, rather than increase the US dollar. And that especially if they stop buying US bonds and the money for these bonds come from within the US rather than from the outside. And countries start to get annoyed with the US's trade policies and start boycotting US product, et cetera, et cetera. Demand for the US dollar is not going to be as strong as the models forecast. So anyway, that's just my 2 cents for everybody who's hearing that the Canadian dollar is just in the tank and getting worse and worse and worse. Not so fast. Anyway, that it's not a question, it's a comment.
No, and I completely agree with you. And it was what happened in August, right? So the Bank of Japan increased interest rates, and people unwound the currency trade. So they were buying US dollars to buy the Magnificent Seven, and that caused that volatility because, again, it's that Fortress America, US exceptionalism, and like people are hiding in the United States, and that's the big concern. If there is a hiccup, everyone's running for the exit at the exact same time, and it's to be mindful of that, right? They're the Magnificent Seven, they're trading at extremely high multiples, but can they keep those earnings up? And there could be other opportunities here in Canada, especially if we kind of clean up our act and things along those lines. But Theresa May in the United Kingdom, she decided to cut taxes, and you had bond vigilantes kind of end her career. I think she was there for 2 weeks. She got a full pension though. And before my time, but Bill Clinton in the 1990s, he also wanted to do spending and things along those lines, but the market just didn't accept it, and it caused a lot of volatility in the fixed income market. So there's nothing to say that that can't happen again, especially with the United States, in a year issuing $3 trillion. We'll see what the Doge can do with regards to balancing or trimming fat, but they're issuing a lot of US dollars, which is depreciating it, right?
I mean, and that whole Doge thing, if a lot of people are unemployed, it's going to be a downward pressure on interest rates, which is a downward pressure on the dollar. There's a whole bunch of competing variables. But anyway, that's another conversation.
Well, absolutely right. And I think the US budget is $6 trillion. They're going to cut $2 trillion, but 2/3 of that, like, it's impossible to cut that. I don't know how they're actually going to get those $2 trillion without cutting entitlements.
Vince, there's a lot of bad news out there today. So, I mean, you've got the LA fires. That's a tragic scenario. You've got what's going down south. Can you give us and investors and clients some positive news? What are some uplifting things that you see on the horizon, either with regards to markets, investments, anything positive, so we can kind of start the year on the up on that side of things?
So yeah, sorry. So don't fight the trend, right? The US market, markets follow a trend, and usually if they're upward sloping, they'll continue to be upward sloping unless acted upon by another force. So the markets are forward looking, so there's a lot of innovation that's happening, right? And if you look at those unemployment numbers that I showed you, those unemployment numbers, like, unemployment should have increased, but due to productivity changes, so single mothers staying at home are able to work part-time because they can just Zoom into meetings, people with disabilities that can't go into the office. So the labor force is expanding. You're getting artificial intelligence, which is increasing productivity. So, there's a tremendous amount of innovation and change that's happening. It's just like these hiccups with geopolitical risks, and we're fighting each other when, if every human just got along, it would just be a lot better for everybody, right? And, you can't pray for that or world peace or anything along those lines. But if some political campaigns, so if the Conservatives get into power here in Canada, Trump's in power in the United States, they're a bit more politically aligned, maybe they won't be butting heads as much. That could offer us a little tailwind for our growth and things along those lines. Polyev does support oil and gas. Maybe we do get LNG exports to Europe, because Europe definitely needs it to reduce the dependence on Russian oils. So there's all these opportunities. It's just bickering over needless things that I think everyone just needs to look at the big picture. And stock markets are forward looking. They go up 7 out of 10 years. And if you just maintain your discipline with regards to your risk return policy, risk return profile, like I showed you that last slide, you'll probably hit your goal. Don't have the knee-jerk reactions, just like, oh, Trump's doing tariffs, and this morning he's not, right? You'll make poor decisions based off of those knee-jerk reactions.
Well said. I mean, it's good to remember that within any given year, I mean, markets generally are down at some point, but as you pointed out, I mean, 70% of the time, markets finish strong. So good context. I mean, we've had a good few years, so could there be a blip? Very likely. But to your point, I mean, sticking it out and knowing what's under the hood, diversified portfolio, having broad reach and not just owning kind of what's shiny, hot, and performing. At least that's how we help clients, and how you've helped put that together, so we can build these portfolios that can withstand whatever the economy and markets are throwing at us.
And I know that you guys use F&P, so you have Elon, David, and David. They're great at positioning, and when you listen to how they talk, they're really positioning the portfolios. As ETF strategists, a lot of our competitors are passive-based products, so they're handcuffed, right? So 1/4 of their portfolio is in Canada, and Nortel went from 0 to 1/3 and back down to 0, and they're handcuffed. And a lot of our other competitors, they have the Magnificent Seven, or the top 10. Magnificent Seven's 1/3, let's say, and it's 1/3 S&P 500, and they're handcuffed on the way down. At least our products, on the factor-based approach, we go through and screen to make sure we're buying quality companies at fair prices. So we are doing that due diligence that offers downside protection relative to passive. And then, of course, David, Elon, 10-year, 100% Piers Bean or something. Claudine probably knows, 5-star Morningstar rating. Like, we have a depth and breadth of knowledge of managing money, and it's not timing the market, it's time in the market that usually dictates your success and your financial goals.
Well said. Pierre, did you have any other last questions before we look to wrap up?
No, I think you covered a lot of what we wanted to talk about. Erik, some of the questions that you brought from the clients were amazing. It is about investor discipline. It's not a set it and forget it strategy, but it is time in the market as opposed to timing the market. Very, very important. We can show you all sorts of charts about, if you miss the best 10 days in 5 years, how much worse your returns will be, et cetera, et cetera. But regularly meeting with your advisor, regularly rebalancing or evaluating the investments and rebalancing your portfolio is key. So, which is why, you might feel it's a little spammy, but it's why we send out a lot of reminders to meet with us at least twice a year, ideally. And then also why, Erik and I spent a lot of time talking to people like Claudine and Vince and their colleagues, learning about what's going on in the markets, what's going on in the different products, to make sure that we're suggesting the best portfolios for ourselves, our families, and our clients, which ideally should all be concordant. So really appreciate it. It's an interesting day, of course. Trump is now president. It's Inauguration Day. We also remember Martin Luther King Jr. And most importantly, Erik, as I mentioned earlier, it's Bills Victory Day. So go Bills.
Yeah.
Hopefully we do a couple more webinars where I can go on at length about the Bills and how they beat the Chiefs and whoever else it'll be to get to the end and win the Super Bowl. So that's the plan.
Right.
Yeah.
Good.
So thank you, Vince and Claudine. That was awesome. I'll throw it back to you, Erik.
Yeah, I'll just throw in one other comment. And this is a pet peeve of mine. We always talk about markets like it's some magical thing. It's really companies, and the selection of the companies that you own are really important. So you want to, as Vince pointed out, and Claudine, make sure that it happens, is that the managers that manage these portfolios buy companies that have value, that are well priced, that are profitable, that are not, and you'll never go wrong owning good companies that are profitable, that are well managed, and carrying other products like bonds for the tough times where you need to draw money out every year and you don't want to sell your good companies when they're being undervalued. So as long as you live by that formula, and we do it in Wachman Wealth, you will never have a problem. You'll never have to worry about your retirement or anything else. And it certainly makes me feel good knowing that that's become part of my life these days. Okay, thanks. I'm signing off, and I'll leave it to you guys to say goodbye to everybody.
Sounds great. Thank you, Jeff. Thank you, Per. Big thank you to Vince and Claudine as well from Fidelity, our one of our big partners on the investment side of things, and really value your support and all your wisdom today. So big thank you for taking the time. Thank you to all our participants. You can expect to receive, if you had to jump out early or you want to re-listen, we'll be sending out the recordings within a day or so once Leah and everybody's got the approval. So you can keep an eye out for that. And we look forward to welcoming you on another webinar. And if you want to chat about anything, about markets, your portfolios, about your plan for the year ahead, please don't hesitate to reach out. We do our best to be proactive and reach out to you. But if anything comes up, we're always available and free to meet. So on that note, we'll thank everybody on behalf of the WWH Financial Group. And we look forward to seeing you again soon.
Thank you.
Thanks, everybody.